Lenden. I'm really pleased to be able to tell you a little bit about the work I've been doing for the last year or so. I'm an entrepreneur, right? I'm not really a venture capitalist. I never really wanted to be a venture capitalist. When I talked to Phil about coming to the program, I was pretty clear with him. He says, you know what? You're exactly the type of person we want in the program. And I'm going to tell you why maybe he thought that and what I've been doing with my time the last couple of years. The Biotech Venture Capital model is broken, and I know this because I've seen it up close. As an entrepreneur who started 2 companies, the first Receptos, which went public in May, by the way, so thank you, and Abide, which also did a huge deal with Merck, also in the same month. You know, it was the strangest thing. So very comparable in terms of the profile of the company. You know, academic spin out, needs to take a technology platform and find a partner for it, needs to develop a preclinical compound to the point where you can put it into humans. And you know, Receptos needed a huge amount of capital because of the way that we were going to launch the business and the sort of the hog feature of the technology platform. Whereas Abide was going to actually operate much more leanly. And if you look at the time periods, right? So we're in the middle of the financial crisis for Receptos. And we're in sort of a 2010, 2011 time frame for Abide. So you'd think, you know, Abide should go a lot easier. At least that's what I told myself. Well, I was wildly wrong. Abide took so much more time and energy to get off the ground. And I started to wonder, you know, what's going on here? And along the way, I realized, you know, I've got a huge problem. Who is going to fund my next company? So when you look at the face of the market, in terms of the dollars that are being invested in U.S. biotech venture capital, it's actually really healthy when you look at it. 3, 4, maybe $5 billion a year getting spent. Deals have been on the uptick over the last 10, 12 years. They've sort of leveled out. But this is misleading, and I'll tell you why. You know, the classification of these deals in terms of seed or early stage actually is pretty funny. There's some early stage deals out there that are $40, $50 million financings that are going into companies right before they go public. And so I look at it differently. When you look at sequence, so not ABC, but sort of tranching of investments, what you see is actually we're experiencing the lowest level of institutional venture capital investment in first-time financings of biotech companies ever, right now. Okay, so this is what I was feeling when I was trying to do a buy. And I'll tell you, if you look at the primary market for the money that we use in this industry, the relationship between the limited partner and the GP, it's way worse, right? So here you see a massive fall off in the amount of money that's actually available in life science focused funds. You know, this is a 10x change going the wrong direction, right? This is not what we're looking for. So what's going on? Well, apologies to anybody who's represented on this slide. This is CalPER's biotech portfolio as published about 2 years ago. Showing $1.2 billion of commitments, earning an IRR of almost 3%. You know, I guess the CalPER people are probably sort of bummed out about this, right? And they changed their course. You know, this was in the news about 18, 24 months ago. They changed their VC allocation from 9% to 1%. That's a 10x change, going the wrong direction, right? And so this is having a massive effect. Dislocation in our industry. You know, biotech firms are straight folding, or mixed funds are completely jettisoning the biotech stuff from their strategy. And this is having a massive dislocation. And so, you know, it's starting to feel like the game of survival, right? Who is going to outlast? Who's going to be there, you know, when this is all come to a conclusion? And so, I wanted to know what were the incentives that really got behind this. And so, started to look at some of the money, and I'm totally convinced that this is a capital efficiency issue. You know, here you're looking at 600 successful exits in 2000 to 2009, right, where there's absolutely no correlation between the exit value and the amount of money invested. And so as much as we might want to think it, you know, capital is not a value driver, right? But you can also see this from this data. Over $50 million was invested in these successful companies. Now, mind you, successful. This is very important. And on average, they're generating a 3x multiple. And so, why can't a 3x multiple generate something better than a 3% IRR? And I'll tell you, this is only the successful companies. If you try to time match the number of companies that were actually started in that sort of time period for exit, something like 10, 12, maybe 15,000 companies in the United States alone. What happened to all that money, right? And I'll tell you, that's what's going on in biotech venture capital. And the reason why this is so important is, you want to generate a 5X and you're going to put $50 million to work, you got to get to 250. In this data set, 250 as an exit multiple is very rare. Less than 25% of the deals will actually generate that kind of a multiple. So interestingly, Bruce Booth actually publishes on the correlation between multiple and investment level. And here you see a very strong negative trend, right? Well, duh, you invest more, you make a lower return because the exit market is not driven by how much money you use. I mean, it's sort of simple math, but I think people need to sort of start to grok this from an organizational perspective. So we need to invest less to make more. How do we do that? When there are perverse incentives everywhere in my world that push you away from that. These are okay, right? Bigger funds need to put money to work. GPs rewarded for being able to raise larger funds as opposed to generating returns, and the list goes on. And so, some of you will recognize this format. I apologize, it's a little garbled. But I would argue that the value proposition of the life sciences venture capital world is now returns, and the primary customer is the limited partner. You've got bigger and bigger funds. You've got more and more of their time spent on syndication and negotiating terms amongst themselves. And I'll tell you what this has done. It has completely nullified the validity of any of the alternative financing situations that people in technology are able to access, right? Crowdsourcing, angels, all that stuff, irrelevant. You know why? Because none of those people have the capital to stay with those cap tables up through the $50, $75, $100 million that these big funds want to put to work. And when they don't, they get crushed. So there's no incentive, and it's killing the entrepreneurs. So I said, well, it was in this very room. I said, I don't like that model. I said, well, why don't I fund my own next company? And what I did was I started with a blank piece of paper and said, how am I going to build it? And first and foremost, change the customer, change the incentive, change the model. So a dual focus on both the entrepreneur and the pharma companies with whom I have to form very deep and strategic relationships because they're the ones who care more about product innovation than anybody, is where you start. And then fundamentally you change the incentives. Common stock is almost prohibited in most typical venture capital firm relationships with their portfolio companies. I want to bring that back into the mix, right? I want to have GPs as co-founders of companies that are going to be able to succeed dramatically when those companies do well. I want to de-emphasize carry to a certain extent, and I certainly want to de-emphasize fee. And so the rest of this model gets filled out with things that are much more positive in my opinion. But what it is becoming the Product Innovation Fund. I'm now working with 2 partners to raise a fund that's going to have strategic companies, pharmas as its primary LP set, to fund innovation through a capital-efficient selection and execution strategy in an organizational model that's completely different, that removes the perverse incentives to keep things going as opposed to kill them early. So call it aggressive but humane portfolio management, right? So you don't have this massive dislocation for people in their lives when you actually turn projects off. So what can happen? A, I think we can change the incentive structure when you change the model. B, I think we can bring money back into the early stage investing scene for life sciences companies. C, I think we can get the efficiency changed dramatically by putting in features into the investment model that are essentially driven around getting better information from the strategics you're working with about which projects they care about, and commitments to them not to continue to fund the projects that they tell you they're not willing to co-invest in. Because if they're not willing to co-invest now, they're not going to buy it 2 years from now. The other thing I think you can do is dramatically change the timelines and the return capabilities on modest multiples, which is what this industry tells you. Don't bake an investment model on 10x returns, even 5x for life sciences. They're just not there on average. So, but you shorten the timeline, and guess what? Your IRR goes through the roof relative to typical fund when you're doing 3, 4, 5x deals. So, that's what I'm up to. Let's see what happens.